Welcome to The Explainer. Today, we're going to borrow a page from Warren Buffett's playbook and use his legendary checklist on the insurance company Assurant. In just the next few minutes, we'll find out if its financials are telling us there's a hidden gem here.
You ever just stare at a screen that looks like this and feel completely lost? I mean, it's a wall of numbers, charts, ratios. It can be overwhelming, right? But what if I told you there's a simple, really powerful way to cut right through all that noise? All right, let's dive right in. We're going to take a look at this insurance company, Assurant, and we're going to do it by asking 5 and only 5 straightforward questions. Think of it as our roadmap to figure out if this is an interesting company from a value investing perspective. So here's the game plan. We'll look at profitability, then growth, then how they treat shareholders. After that, we'll ask if the price is right, and we'll wrap it all up with the most important part, the margin of safety. Let's get to it.
Okay, first things first. Is this company actually good at making money? I mean, if a business isn't profitable, you don't really want to own it, right? This is the foundation for everything else we're going to look at. So, first up is return on equity, or ROE. The easiest way to think about this is like a report card for the management team. How good are they at turning our money, the shareholders' money, into more money? Well, at almost 15%, Assurant is getting a pretty solid grade.
But here's the thing. A high ROE can sometimes be a bit of a trick if it's just loaded up with a ton of debt, but that is not what's happening here. That super low debt-to-equity ratio of 0.38 tells us this company is making its profits the old-fashioned way, not by taking on a bunch of risky debt. That's a really healthy sign.
So let's move on to our next big question. A profitable business is awesome, but we also want to see that it isn't just standing still. Is it actually expanding? Are its earnings growing over time? Let's check it out. Whoa. Okay, now this is where the story starts to get really interesting. You can see the revenue growth has been nice and steady, but just look at net income and free cash flow in the last 3 years. They've absolutely exploded. This tells me the company isn't just getting bigger, it's getting way more efficient and way more profitable. Something clicked recently.
So, we've got a profitable, growing company. But what about us? You know, the actual owners. A great business has to share the love with its shareholders. So let's see how Assurant does on that front.
21. Just let that sink in. For 21 years in a row, Assurant has given its shareholders a raise. That is more than just a dividend payment, my friends. That is a loud and clear message about financial strength and a management team that cares about rewarding its owners. And get this, they aren't even breaking a sweat to pay out those raises. They're only using about 19% of their profits for dividends. What about the other 81%? Well, that's being plowed right back into the business to grow it even more. It's kind of the best of both worlds. You get paid now, and your capital is compounding for the future.
All right, so we've got a solid, growing, shareholder-friendly company on our hands. But here's the thing about value investing, and this is so important. You can't overpay. It doesn't matter how great the company is. So the big question is, are we getting a good deal at today's price?
You know, just at a quick glance, these numbers don't look expensive at all. The price-to-earnings ratio is a pretty reasonable 13. But the one that really jumps off the page for me is that PEG ratio. A lot of value investors see anything under 1 as a huge green flag. It suggests the price might be cheap compared to how fast its earnings are growing. And at 0.73, its sales pass that test.
And that brings us to the final, and, maybe the most critical question on any value investor's checklist, the margin of safety. This is your ultimate protection against being wrong. So here's the big idea. It's simple, really. We want to buy $1 for 50 cents. We need a huge cushion, a big gap between what we think the business is actually worth, its intrinsic value, and the price we're paying for it on the stock market. Okay, so this is where things get pretty wild. The stock is trading for around $229, but when you estimate its true value based on the cash it's expected to generate in the future, you get a number that is just dramatically higher. Now, yeah, these models always have assumptions built in, but the sheer size of that gap is exactly what we're looking for. So what does that gap actually translate to? A potential margin of safety of almost 82%. What this calculation is screaming at us is that, based on its future potential, this stock could be worth a whole lot more than where it's trading today. That's the huge theoretical cushion that helps value investors sleep at night.
So let's just run through that checklist one more time, real quick. Profitable business with low debt? Check. Accelerating growth, especially recently? You bet. Check. A long history of rewarding its owners? Big check. And finally, an attractive price with a potentially massive margin of safety? According to the numbers, that's a check too. Look, running the numbers through a checklist like this is a fantastic starting point. I mean, the data tells a really compelling story. But it leaves us with one last, absolutely crucial thought. A checklist like this tells you what is happening, but it doesn't tell you why. It can't tell you about the quality of the CEO or about the company's competitive moat or the big risks its industry might be facing down the road. So the real question is, what would you ask next?